Welcome to today's market report.
Global stock markets rose on Friday as a better-than-expected US monthly jobs report signaled a strong end to the second quarter for the world's largest economy, while US bond prices fell as investors worried about the Federal Reserve's response. Data showed US job growth accelerated in June as non-farm payrolls increased by 850,000 jobs after rising by 583,000 in May, although the unemployment rate rose to 5.9% from 5.8% the previous month. Economists polled by Reuters had forecast payrolls advancing by 700,000 jobs. The MSCI All-Country World Index gained 0.42%, while the Pan-European Stock 600 Index rose 0.26%. On Wall Street, the S&P and the Nasdaq hit record highs. For capital markets, equities and bonds, this was a Goldilocks report. According to Wells Fargo, this was perfect. There were enough jobs that you'd want to see, but not so many that it concerns people that the Fed may have to act sooner. Still, gold edged higher and the dollar fell from a 3-month high as investors weighed prospects that Fed policy would tighten following the job report. The Dow Jones Industrial Average rose 0.44%, S&P gained 0.66%, Nasdaq gained 0.68%. Prices for US government 10-year notes fell to yield 1.43%. Eurozone government bond yields fell as investor fears over the rise in COVID-19 cases outweighed strong US data. Germany's 10-year bond yield, the Eurozone benchmark, dropped to minus 0.24%, its lowest since mid-June. The dollar slipped from a 3-month high, pressured by the weaker details of the non-farm payroll report. Oil prices ended the week mixed. Brent crude settled up 0.44% and crude settled down 0.09%. OPEC Plus resumed talks on raising oil output a day after the United Arab Emirates blocked a deal. The standoff could delay plans to pump more oil through the end of the year to cool prices that have soared to 2.5-year highs. The spot gold prices rose 0.27% to $1,781.31 per ounce. On the FX front, the GBP/USD is hovering near 138 after a sharp recovery from 137.30, the lowest level since mid-April. The pair bottomed immediately after the release of the US employment report and then bounced to the upside as the greenback reversed, falling across the board. Non-farm payrolls rose by 850,000, surpassing expectations. It was the best month in terms of job creation since August of last year. The dollar rose initially but then changed its directions. Profit-taking and probably buy the rumor, sell the fact behavior triggered the decline. The dollar index dropped from monthly highs back under 92.50. Next week, the FOMC minutes of its latest meeting would be the key event in the US. The short-term momentum still shows some strength in the dollar that will be challenged over the next sessions. Wall Street will remain close on Monday. Regarding the pound, analysts at ING point out that it held up better than most of G10 peers to the dollar's appreciating trend, which also denotes how the market continues to see the recent sharp rise in Delta variant cases in the UK as unlikely to derail the country's economic recovery. Key data next week, including the GDP growth in the UK, will be watched, but more importantly, the speech by Bank of England Governor Andrew Bailey will be drawing more attention. The euro-dollar pair fell to its lowest level since early April at 118.08 in the early American session on Friday, but managed to stage a rebound after turning positive on the day above 118.50. However, the pair lost its momentum and was last seen posting small daily losses at 118.44. The non-farm payroll figure has supported the dollar against the euro, whilst the data from the euro area showed that the producer price index rose to 1.3% in May from 0.9% in April, but this data was largely ignored by the market participants. According to Credit Suisse, euro-dollar could target 170.67 with a break below 118.24. The next short-term support is seen at the 78.6 retracement of the March-May rally, just below at 118.24, which the market is testing this morning. A break below here is expected, which should see a move to the lower end of the convergence range, now at 170.67. More importantly, medium-term support remains at 117.03 to 118.95, with only a weekly close below here suggesting a medium-term trend turn. Dollar yen has gained 3.1% since the last extensive dip in late April at 111.44.
This is today's market news. Thanks for listening. We'll see you next time.